Investors Chronicle.
Hello and welcome to the IC Interviews. I'm Chris Akers. I'm delighted to be speaking with Dr. Paul Jourdan, CEO of Amati Global Investors. Paul co-founded Amati in 2010 and previously worked for Noble Fund Managers in Stuart Ivory. Amati are based in Edinburgh and focus on the small and mid-cap markets. Paul, thank you for speaking with me.
Great pleasure. Thanks for having me on.
Now, for our listeners who aren't aware of Amati, can you give us an overview of your funds and assets under management?
Sure. Yeah. So we have a UK smaller companies fund, which is an OIC. Our products are all very much sold just in the UK currently. The small companies fund is a fund I've been managing for, well, actually an embarrassingly long time, but something like 21 years now. I started, it was a first state fund originally. It followed me to Noble Group when I moved there in 2007. And then it was one of the funds we had when we started Amati in 2010. So there's been continuity. So I feel like it's been a big part of my life, this fund. And that's about, it's about £1 billion under management in that fund. So that's our biggest fund at the moment. We also have a venture capital trust called Amati AIM VCT. And that was a fund that, again, dates back to First State. I started managing a VCT in 2005 at First State Investments. And that, again, came with me to Noble Group and then was a core part of Amati when we started it. In fact, it was the biggest fund in Amati right at the beginning back in 2010. And it's grown. It grew early on through us adding in a couple of other VCTs, which we were invited to take over the management of. One was called Victory VCT and the other was Invesco Perpetual AIM VCT in 2010 and 11. We took those over, and over the time we've merged them all together. And the final merger was 2018. And that VCT is now just under 300 million under management. So it's grown a huge amount. I remember when that fund started in 2005, it was an incredible amount of work to raise £10 million for it. And I think we started with 10 or 11 million, which was a perfectly viable starting point, but it's been a long road to get it to the kind of scale it now has, and it's got it's really benefiting a lot from having that sort of scale. And then we run some AIM portfolios for people who for advised clients who want to benefit from the inheritance tax advantages of owning AIM stocks directly. So that's the only service we run where it's structured so that the clients own the stocks directly rather than through a fund, but we run it like a fund. So every client we have has the same portfolio. Some managers approach this rather differently, or like a private client fund manager where everybody's got something different. We really try and run it like a fund. So there's a model portfolio and all the clients replicate that. That's about £50 million under management. And then we have our newest product, which is the Amati Strategic Metals Fund. This is we started back in March this year. And that's run by a different investment team, George Lequiem and Mark Smith, who have 25 years experience each pretty much of investing in global mining companies. And the idea of that fund is to invest strategically in across the kind of mining spectrum for metals. And there's two aspects to it. One is obviously the extraordinary potential demand there is as a result of electrification of transport. It looks like it's very much going to be demanded as part of energy transition, and that's creating all kinds of extraordinary new sources of demand for certain types of metals. Difficult to predict areas of demand when you're dealing with an industrial change like this. You can't take anything for granted, and very often extrapolating into the future is incorrect. It's obviously tricky in this area, but we do know that an awful lot of new materials are going to be needed. So think of lithium batteries as a good example, and there's all kinds of different chemistries involved. But we know that lithium batteries are already dominant enough that they are going to be used in pretty big volumes. There may be, and we very much hope there will be other chemistries that come along to supplement it, because I don't think we'll have enough of the raw materials for the lithium, cobalt, nickel, manganese type chemistries that are the highest performing kind of batteries at the moment. But there'll be other ones that come in beneath, and they'll all create their own demands. But part of the idea of that metals fund is to be able to invest in providing the raw materials through mining. And the other side of it, and we wanted to have a flexible mandate so that the investors could own it really for the long term. And the other side of the coin is precious metals, which have a very different sort of investment dynamic, or are also part of the mandate. So gold and silver, which are more defensive type investments, and really allow the fund to have ways of maneuvering through different phases in the cycle. And it's very important to us when we construct a fund that we do so bearing in mind that the stock market is really a bit of a manic depressive, and you know, in the classic sort of Benjamin Graham type sense, that you know, there are some decades it's fantastic, and other decades it's a nightmare. So we want funds that can be structured and have enough options that they can invest for tough times or they can invest for good times. And you know, in designing a fund mandate, I think that's pretty important, and we try to do that. And our idea really is, you know, we see ourselves very much as providing products for the UK investing public. That's, you know, we're UK investors ourselves. I like to think, you know, one of our guiding principles in working out what to provide for funds is to devise funds that we want to invest in ourselves, and, you know, in ISAs, in pensions, and, you know, they need to be things you can hold for the long term. They need to have sensible risk management. They need to be not only trying to do one kind of thing, it will only do well in one kind of environment, and we're very conscious of all of that. So that's really our emphasis, rather than trying to devise the kind of raciest funds that might be the top of the tables one year, but or even longer, but, you know, might then go through periods when they do terribly badly. So it's you know, risk management is quite high up there.
Now, with that new strategic metals funds, there are often ESG concerns around metals and mining. How do you deal with that at Amati and with that fund?
I think we pay a lot of attention to it, is the first thing I would say. That, you know, there are ESG, and I like to call it ESGH, and the H for us is human rights. It's the kind of big omission in a lot of investment discussion these days. But ESGH principles are absolutely core to the way we run funds. But I'm very wary of simply jumping on bandwagons with this, and I'm not so much interested in labels, and I'm much more interested in what makes a difference. And I'm wary of the idea of you know, a regulator coming along and saying this is what this means, and so we're trying to avoid terms which are defined by regulators or outside parties. And I think ESGH only makes a difference if the fund managers are leading the charge and involved in figuring out what matters. And I'm very much not wanting us to get tangled up in endless box ticking, or the other thing I'm wary of in this area is doing things which cause huge amounts of money to be spent on consultants to come up and draw up metrics, which in the end really don't mean very much. And you know, I think these are significant perils for the industry at the moment. So you know, the things which matter to us in terms of mining, you know, number one, what jurisdiction are you mining in? And this is a human rights issue, which I feel pretty strongly about. And we call it pretty much broadly the clean trade approach. And that was a term coined by a writer, well, an academic called Leif Wenar. He was at King's College London. Now he's at Stanford University. He wrote a book called Blood Oil, really very much pointing out the human rights implications for the international trade in commodities. And if you this, so I don't want to go into too much detail, but this goes back to Article 1 of the two international covenants on human rights. Article 1 is identical between the two of them, and it talks about the distribution of natural resources that needs to be disposed of for the benefit of the people who live in the country where they come from. So that's the top principle in a way. If we don't feel that in extracting those resources there's any benefit going to the people of the country where it came from, then, you know, we draw a human rights principle there, where we won't invest, you know, for that reason. And actually we're using Freedom House scores as a kind of indicator of when that's likely to be the case. And I would say we're not trying to draw the line very high here. We're trying to exclude the most extreme situations. And the reason is because, of course, that investment in the country can make all the difference to the inhabitants of the country. It's hugely important, that kind of investment. But there are some situations which are sufficiently bad where that investment really has no chance of making any difference to the population. So then we don't go. And you can see that written up in our documentation. And I think we're maybe unusual. It's an idea that I'm really keen to have wider adoption of in the city. I don't want it to be proprietary to us. I'd love it to be adopted.
Thank you. Now looking at your funds, could you tell us about one or two of your favorite holdings and why you like them?
Now, this is always a really difficult question because the funds have a lot of stocks, and it's a bit like, what's your favorite piece of music? Well, I love many different bits of music, and we set a lot of store by diversification. So we want companies that are doing a very wide range of really different things. There's a company called Accesso Technology, which we've known for 20 years plus. It's an interesting business, had some really big ups and downs in its life. It started off very much as a lifestyle company, which came to market with a really important piece of electronic queuing technology. And interestingly, it had the global patents for electronic queuing. And it turns out that's a pretty important area of activity. Its main application was theme parks, and which in many senses are global queuing parks. If you've been to one of those, then you'll know that a lot of queuing is involved, and making it electronic, of course, is hugely sensible. And then there was a change of management, and the company really kind of got its act together following that, and became much better at selling its products, but also made some acquisitions. And it's now become, through those acquisitions, bought a company called Accesso, and that's why it changed its name, which is one of the largest global online ticketing companies. And it had a very successful period, and then a very tough period when actually its strategy it kind of went wrong effectively, and it had a few dead ends. The shares collapsed to a pretty low level, and it was a stock we bought into with the Small Companies Fund during the pandemic, because we thought, well, actually, this business has a huge amount of capability to re-establish itself as one of the most important online ticketing companies, online queuing businesses. Obviously, it needed leisure parks to reopen, which they broadly have. And what was going on behind the scenes corporately was refocusing the business. The original chief executive of Accesso, who was very talented, extremely capable manager, came back into the business to refocus it, and that's been done pretty effectively. So that's been one of our kind of rebound stocks over the last year. It's been a very good experience to own it. It might be worth talking about a mining stock, which we have in the Small Companies Fund. I won't talk about too many because obviously this is George and Mark's territory, but it's one we co-own with their fund. It's called Atalaya Mining. It's a copper mining company in Spain. This company has been very effectively run under its current management team, which doesn't go all the way back. It had a bit of a stuttered start to its life, but when the right management team took over the assets, it's become very effectively run. And it's got one of its issues is that it's a relatively high cost producer of copper. So it's a copper miner, and copper is probably the most sort of surefire strategic metal, because copper and electricity are kind of joined at the hip. Copper is the most efficient metal for transporting electricity around. Yes, there are other ways of doing it, and there are certain ways of substituting it, but it's essentially very difficult to substitute for most of its applications. It takes 10 years to really discover and open a copper mine. It's a very long and difficult process, so the barriers to entry are very high. Atalaya's mine in Spain is actually called Rio Tinto, and it was actually the original project which Rio Tinto itself was created with. So it's a historic mining district in Spain, and because it's now quite low grade, it's been relatively high cost production. So that put me off it for quite a long time. And the reason why we've got switched on to it as much as we have, I think, is in part because they've developed a very innovative and they cultivated a very innovative new processing technology, which has been developed by a lady from a doctoral graduate from Cambridge University, who's come up with what looks like a really interesting new processing technology. And insofar as they can apply this to their mining, they can actually open up a number of adjacent deposits near the Rio Tinto mine, which are already zoned for mining. and are higher grade, but they're refractory ore, so they need, they're complex ore. They need this kind of processing to make them flourish. And I'm personally pretty optimistic about the company's ability to do that. And I like the application of innovation to helping to solve the meeting the demand issues for copper. And it's a Spanish jurisdiction, so it meets our criteria for where the metal is coming from. We think it's a very well-run company. They do also have another mine that they're trying to open in the north of Spain called Turo, and they're applying for the permits for that. Whenever you do this kind of thing, you tend to get some local opposition, and they've had some local opposition. They've also had a huge amount of local support for the project. So we're very much hoping they'll get that permission. So there's a number of growth prospects for this company, but I'm particularly interested in the processing technology that they bring to bear. And of course, it's benefiting hugely from the strong demand for copper that we're seeing. And then another completely different kind of company. Let's talk about this is one that's right at the small end of the small companies fund, and it's in the venture capital trust as well. A company called Saeta. This is a recent float. This is really about us trying to back what we think of as the most important innovations for what we're trying to achieve globally. So I think for me, responsible investing is much more. It's not so much about what you don't do. It's partly about what you don't do. And in terms of what you don't do, I put human rights as being the defining category of the things which define your red lines. But in terms of what you should positively be trying to do is we're trying to foster and support the companies which we think are bringing the most important kind of innovations. And Saeta, when we met, it was a company that had spent 3 years plus designing a pretty fundamentally new kind of new design concept for electric motors. And this is something called an axial flux electric motor, whereas most electric motors used today in pretty successful vehicles, in cars like Teslas and Toyotas, would be radial flux motors. And that radial flux technology has been pushed pretty much as far as it can be in terms of efficiency. But axial flux is a fundamentally more efficient design and has some really significant advantages. Saeta had kind of, the way they put it as a company, they'd gone into stealth mode. They'd done 3 years of R&D on this. And we think they designed a very elegant solution to bringing a commercial axial flux motor to market. And so, it was a UK business. It needed capital to take its next steps. And the venture capital trust went in first. We made a pre-IPO investment, which enabled the company to float, gave it the financial confidence to float. It also enabled it to immediately start making new hires and planning bigger. And then 3 months later, it floated and raised £35 million, which is completely transformational for that business. And so now it's really got a shot at commercializing itself effectively.
Now, looking at your website, it seems as if you have significant overseas exposure in your portfolios, even in the UK smaller companies fund. Is that accurate? And can you explain your thinking behind that?
Yes. So the thing not to be confused by that is that what that's analysing is all the companies we invest in the small companies fund are UK listed. So we buy the shares in London. But some of them are dual listed overseas, of course, but they all have a London listing. But they sell all over the world. And that's what you'd expect from enterprising London listed companies. You wouldn't expect them to be selling in the UK. And we monitor how much of their sales are UK facing, how much of their sales are overseas facing. And we deliberately, it's consciously, we advocate having more than just UK sales exposure. And it's very much a point about diversification in the fund, that we want our companies to be succeeding not just in the UK market but in global markets. And that sort of mix that you see on the website about overseas sales is really a measure of that diversification.
That makes sense. That's great. How do you view the attractiveness of the UK market compared to investing overseas?
Well, yeah, I think what we have in London is a world-class stock market, and it's very important. I believe it's very important that the UK public understands the value of that. We've got one of the best stock markets in the world, it's an extremely difficult thing to create. It has there are some issues around that to do with monopolistic behavior, and the London Stock Exchange doesn't always help itself by becoming a bit too monopolistic and not putting enough emphasis on making it cost effective to be listed. But it's a world-class stock market, and the reason it's world-class is very largely regulatory and legal, and those things sound boring, but they're just massively important. It's a stock market. As an investor, you can depend on it to function well because it's well regulated. It has it's part of it. It's in a jurisdiction where there is the rule of law, and the rule of law is independent, and it's the law is applied independent from executive control, and so you have those kind of protections, and around that in London you have deep pools of capital. You have the City of London, which has a massive workforce which supports it, and all of that is they're very high barriers to entry with that, and London's really on a par with New York in that respect, and we should value that as a country because it's one of the UK's really significant assets. So we like to invest with a global mindset, but through London, because we think that structure is really excellent.
Now, there is an AIM focus to your funds. I think around half of the smaller companies fund is invested in AIM, and obviously the VCT and the IHG funds are AIM focused. Do you think the AIM market is working as a venue for high growth capital?
Broadly, I do. Yeah, I think it's one of the leading markets in the world for small companies, and there's lots of people who love to knock AIM. I'm myself absolutely not in that camp. I think what AIM's achieved over 26 years of its life is fantastic, and it took the other thing to remember when talking about AIM is it takes a very long time to create a market that's that good, and so I'm more of a kind of glass half full person when it comes to how I view AIM. I think what it's achieved is fantastic and hugely important for the UK, and again it's an asset of national importance, and it is very well supported by policy in the UK, and I hope it will continue to be, because it takes a very long time to create things like this, and it takes a very short period of time to undermine them. So it'd be very easy to do a lot of damage to AIM by either well-intentioned or badly intentioned policy. I think we should really try and understand its importance. It's not to say that I wouldn't like to see some competition come in. And I think the best way of improving AIM would be competition, and I'm interested in what Aquis Exchange are doing. I hold the founder of Aquis in very high regard, and I think if anyone can produce an adequate rival to AIM, it's probably them. So and I'm not an investor in the company, but I'm impressed by what they've done, and they brought some really interesting innovations to what a small company market could look like. And so having some competition would be a good thing, as long as it's not too confusing for people. It hasn't yet been embraced, I wouldn't say, by the broad mainstream of companies that are listing. But it's good to introduce competition for the point of view of keeping costs down and removing that kind of some monopolistic behavior, which isn't helpful in a stock market.
Do you think there is a risk of AIM losing the tax privileges it enjoys? Obviously, we're in quite a high tax environment at the moment. Do you think that's a risk, and is that something you're concerned about?
Yes, I mean, it'd be wrong not to be concerned about that, and it's something we think quite hard about. I think successive governments have really actually understood the value of and the importance of having a public market which can attract capital to high growth companies. So I think the investment that's has been made over a long period of time in AIM through those various tax benefits has actually paid off magnificently. And I think the payoff has been sufficiently large that I'm not too concerned that a policymaker would come along and think, well, this isn't worth it. So there's always the danger of a kind of populist type knee-jerk response to the thing. Oh, this is bad. It's just supporting wealth, wealthy people wrongly. That would. There's always the danger of that. But I think the AIM has been supported by both Labour and Conservative governments over 26 years. if you got a more extreme kind of government coming in, then yeah, we might get rid of it. But I think if you have a kind of broadly centre-left or centre-right government, I think the chances of that are pretty low myself. But I don't take anything for granted, and I'm not a crystal ball gazer there, and we also have to think about the risks of that changing and what that would mean. And we do think about that, but I think it stacks up as a policy. So from that point of the time to get really worried about policies is when they obviously don't stack up.
It's been a very active year in terms of IPOs. How do you feel about the quality of IPOs coming through? You've already mentioned Saeta. I think you've also participated in Victorian Plumbing. Could you chat us through your thinking on that?
I mean, yeah, it's been an incredibly active year for IPOs. It's been a year, in a way, it's been the year of IPOs to a big degree, and that's been fantastic for the sell side in the industry, and to be fair, I think I view that very positively. I think it's the sell side often gets overlooked when we're talking about markets. It's hugely important to well-functioning markets to have a strong and competitive sell side set of businesses out there, and the sell side, by which I mean corporate finance, corporate broking, the companies which are floating these businesses, they were really compressed by a set of regulatory changes and sat on, if you like, pretty hard. So it reduced the number of players reduced. But actually, this has been a fantastic year to rejuvenate the sell side in the industry, and that is a healthy thing. I don't view that as negatively at all. But of course, there's always the risk when you get a kind of IPO boom like that. Then it's too much. It happens too much too fast, and you can also have carelessness coming in, and maybe you can get some lower quality issues starting. But I think in general, the quality of issues has been pretty high, and the issue has more been around pricing, and how much do we? That's a stock market wide issue, and the reason why lots of companies were floating is because pricing was good, and the market was sufficiently buoyant. If you like, stock market ratings caught up with private company ratings, and for bizarrely for a number of years before, stock market ratings were much lower than they were in the private markets, and so you couldn't get very many flotations when that was happening, and then suddenly the public market caught up, partly as a function of the huge amount of capital creation that went on in the pandemic. So the money supply rose at an unbelievable rate in 2020, and that does feed through to asset prices, and the public markets, moved because of that. So that if you like drove up asset prices, and that then led to a big number of IPOs. So I'd say that the main issue in 2021 has been overpricing, but some really good businesses have floated, and we think Victorian Plumbing is an example of that. A company with incredibly impressive track record as a private business, founder-led. You clearly got that entrepreneurial energy and talent and commitment to the business that you get when you have a big founder stake in a company. And we like to see the original entrepreneurs still in place in companies. It can very often be, a very powerful formula. There's no hard and fast rules over these things, but in a company like Victorian Plumbing, Gear for Music's another example of that, where you've got an online retailer that's been incredibly effective at growing that online sales format, and that's because you've still got the founder in place, and you've got that that deep skill set, and that where the business is really oriented to online sales and has it's the whole way the business has been constructed is around that format. And so we're believers in that basic kind of business structure, the founder in place, online sales speciality. We think those companies have got further to go. Victorian Plumbing has gone down since it went up, and it's gone down, and it's kind of hovered around its IPO price. So that's telling you the IPO price was probably a bit high, but we think the business quality is very good. And there are other examples of that. There are some companies that are floated where we thought the quality wasn't so good, and we've been tried to be very selective about how we've invested in IPOs. There's one which is a bit controversial, where we invested after the IPO because it fell significantly. But we think the company is really outstandingly interesting, but it's become, it's had a very volatile ride, which is Alphawave, and that's an IP company selling into the global semiconductor market, and it's selling a very, very particular kind of intellectual property, which is all to do with the way chips communicate with each other. The other sort of controversial, and the thing we do give significant pause for thought over, is to what degree do we deal with China? And this is an investment question that's going to come up in all sorts of different forms in the future. And there's maybe something of broader interest here that clearly when Trump was president of the US, he decided that he would take a confrontational approach with China, and brought in some legislation which forbade US technology companies to sell to China. And so, this is an aggressive approach to take. I personally think that strategically that's completely wrong-headed and will actually produce exactly the wrong consequence, the exact opposite consequence of what it was intended to do. It was intended to weaken China. Actually, what it will do is it will strengthen China, because what will happen is China will just find, it will get more aggressive towards Taiwan because Taiwan holds a lot of this technology. So you're bringing forward the date potentially at which China aggressively takes over Taiwan. I hope that date never arrives, but that strategy of isolating China from technology point of view is going to have adverse consequences in that direction, from what I can see. The second thing it will do is it will force China to develop its own proprietary technology. So you had a situation before where really the US dominated a huge number of technology areas, and China lived with it because it could buy them. But as soon as you say to China, you can't buy these, you're forcing it to break free and develop its own. And yes, that will take time and it will be costly. It's a waste of resources from a global perspective, but it's also not achieving the objective that it set out to do. And those famous words of Donald Trump was, it's easy to win a trade war with China, will just come back to bite massively, and the irony of those words will be profound. So Alphawave is kind of at the nexus of this, because Alphawave is a Canadian company. It's not bound by, and the reason they listed in London is because they didn't want to list in America, because they don't want to be bound by that legislation, and they want to sell their technology to China. And so strategically, the question we ask then is, should we be, as investors, be well, is that something we should ourselves say, well, actually, no, I won't invest in a company that sells to China, or yes, that's something that we can support. And I think in investing in Alpha, we've taken the view that actually strategically that to try and isolate China is the wrong approach. It doesn't achieve anything helpful. I personally take the view that I personally wouldn't want to invest directly in China, in Chinese companies, and again, I've got human rights reason for that. But that doesn't mean that I want to be dumb strategically and make matters worse. I'd love to, I think if we engage in China with China positively, hopefully that's the best way to address our human rights concerns over what's going on. Isolation is not the right way to do it, I don't think. So, that's the kind of deeper level of questioning about Alphawave that needs to go on. But in terms of the quality of the business, the quality of the product, we regard it as world leading. We don't regard the kind of insinuations of circularity that the FT made as being accurate. And we certainly looked into all of those things before we invested, and probing them further since that article came out, we're satisfied that that it was wrong-headed, and that actually this is it's a company potentially rather like ARM technology. It's a company of of global significance in terms of technology and selling IP into the semiconductor industry. It's it's fantastically important, and ARM just proved how effective that is as a business strategy if you get it right, and we think Alphawave can do that. So yeah, we think it's actually it remains a very, very interesting investment opportunity. And that we think that whole sort of FT thing is playing out still. So it maybe needs a bit more time to play out. But we think the company will prove itself.
Given the increase in the money supply, which you've mentioned, and other factors, do you think there is an issue with valuations at the moment, with stocks being overvalued? And is that a concern with your portfolios?
I think there is a concern over that. It's very easy as a fund manager to never want to say that, because of course you want people to invest in your funds, and but I think it's important that fund managers are cognizant of valuation risk at the moment, and it does have implications. It does have implications for how we run the funds, and I think unusually for us, we've pushed ourselves more in the direction of finding those areas of the market where valuation risk is lower, and that means sometimes backing away from some of what look like they might be the highest growth areas, because clearly if we go into an environment where interest rates start rising, and there's a huge debate around that, I think we're more inclined to think that they are going to rise than not. I've read lots of arguments from economists who say that's nonsense, that don't worry about it, inflation's going to tail off next year and this is all going to be okay. A bit more skeptical about that than is comfortable. And so we've got to think through very carefully, well, what happens if we do go back into a rising rates environment because inflation is higher? And I'm not saying that that's going to happen with any certainty, but we've certainly got suspicions that it might. So we need to take account of it as a risk factor. And clearly then what it does is it changes the way you discount the future. And that is quite painful if you've got very, very sort of futuristic investment horizons. And we've seen this many times in the past, that the market then snaps back and starts discounting future earnings in a different way. And so, we're pretty cognizant of that. And I think that's another reason why we really put the emphasis on diversification in the portfolio. We're not a kind of pure sex and violence fund where we're all trying to, looking at what's happening in 10 years' time and saying, isn't that going to be wonderful? We're also very much, while we have some of that kind of in the funds, and Sayat is a good example of that kind of investment, where we think there's fantastic potential in the future, and we're very keen to have some of those companies in the mix, and they've got to be very well chosen. But we've also, alongside that, we're investing in house builders in the UK, and one savings bank, one of the a specialist mortgage provider in very well constructed companies, which are very much more about what's happening here and now. And so having that in the mix is important, and that's because we're cognizant of that inflation / interest rate risk. We've got more emphasis on that in the funds now than we would have had, say, 5 years ago.
Thank you for speaking to us, Paul. Much appreciated.
Great pleasure. Thank you very much for having me on.